Ezra Holdings was once one of Singapore's largest offshore supporters for the oil and gas companies. It was cheered upon by many Singaporeans, especially those who bought shares in the company. It was also led by a visionary family that led the company to achieve billion-dollar revenues. However, a combination of industry downturns, financial mismanagement, and strategic missteps led to its downfall. In 1992, Ezra Holdings was co-founded by Lee Kian Soo. The company initially focused on providing offshore support vessels, OSVs, to the burgeoning oil and gas sector. This was a period marked by robust growth in the global energy markets, which created fertile ground for ambitious firms like Ezra Holdings to flourish. Their company functioned primarily as a support. Whenever an energy company aimed to produce oil or gas in a remote undersea location, it relied on companies like Ezra Holdings. Ezra Holdings provided the essential logistics and ships required to support these operations, even in the most challenging climates and rough seas. This was no easy business and required vast expertise to execute properly. Key to this story is when Lee Kian Soo's son, Lionel Lee, joined the company. The younger Lee joined Ezra in 1995 when it was just 10 employees and operated out of his father's basement. What he wanted, however, was to start a trading arm. It would supply frozen food to shipping companies. Thus, he borrowed about 30,000 Singaporean dollars, around 24,000 US dollars, from his father. Now, remarkably, this venture generated over $1 million Singaporean dollars in its first year. Throughout its years of operation, Ezra Holdings grew rapidly. They extended their operations, incorporating their Malaysian subsidiary as an investment holding company in 2002. A year later, in April of 2003, they entered into a strategic partnership with KS Tech, enabling them to expand their customer base to China. The biggest shift for the company was when they entered the Singaporean Stock Exchange in August of 2003. Their initial public offering, IPO, was 142.3 times oversubscribed, marking one of Singapore's most spectacular company listings. In the same month, they announced a contract that would extend their fleet from 6 to over 12 vessels. By 2000, 8 years after the company started, the total turnover had already hit $8 million. By 2003, this rose to over $21.3 million, with the majority of their operations still in Southeast Asia. $14.5 million in 2023 came from Southeast Asia, $5.9 million from Singapore alone, and $865 million from outside the region. This would change in the coming years. A significant part of their growth was a series of strategic acquisitions aimed at broadening their service offerings and geographic reach. In 2007, Ezra acquired a controlling stake in EOC Limited. That year, the group's revenues jumped to over 218 million Singaporean dollars. They now had access not only to Southeast Asia, but also to West Africa, Australia, the Middle East, and even India. In 2011, Ezra launched EMAS AMC, Advanced Marine Construction, catapulting Ezra onto the world stage. This enabled them to bid for and secure larger, more valuable contracts. This strategic move significantly expanded their capabilities and market presence, positioning Ezra as a key player in the global offshore services industry. This strategic decision was led by Lionel Lee. By 2013, they had a combined fleet of over 65 vessels and were a leading company within their industry. They had over 16 offices globally and assets deployed across 6 continents. They had 4 main business divisions: subsea services, offshore support services, marine services, and production. Collectively, the group generated over $1.26 billion US dollars in revenue. 2 decades ago, they were operating out of the founder's house, yet now they were a leading global company. One of their divisions, the Subsea Services Division, offered comprehensive offshore seabed-to-surface construction services and won approximately $2.5 billion USD in contracts from 2011 to 2013. They were operating in the Gulf of Mexico, Mexico's Bay of Campeche, and other significant areas. The company's success also reflected in its market capitalization, which soared as investors investor confidence grew. Ezra's stock became one of the more actively traded counters on the SGX, reflecting strong market sentiment and the company's robust growth prospects. Analysts often highlighted Ezra's diversified business model and strong order book as key strengths, positioning it favorably against its peers in the offshore sector. Everything was going well for Ezra Holdings. They were growing fast and employing many people, becoming very important to Singapore. Yet, just a few years later, out of the blue, Ezra Holdings would declare bankruptcy. In early 2017, Ezra Holdings, listed on the Singaporean Stock Exchange, filed for Chapter 11 bankruptcy in the United States. The Ezra Holdings stock, known as Ezra, was trading on the SGX. It once rose to over $2 a share in 2007, but fell to about $0.6 a share in 2014. Since then, Ezra stock fell to about $0.1 a share by 2016 and further to 1 cent until it was halted by the authorities. The fall started in 2014. Now, this issue was not unique to Ezra Holdings. Their downfall was caused by a dramatic downturn in the global oil and gas industry, which began around 2014. The industry was severely affected by a sharp decline in oil prices, which dropped from over $100 per barrel in mid-2014 to below $30 per barrel in early 2016. Now, this decline was largely due to an oversupply of oil, driven by increased production from shale oil fields in the United States and the decision by the Organization of the Petroleum Exporting Countries, OPEC, to maintain high production levels despite falling prices. The offshore oil and gas sector, where Ezra operated, was particularly hit hard. Exploration and production companies drastically cut back on new projects and expenditures, leading to a steep decline in demand for offshore support services and vessels. For Ezra Holdings, this translated into fewer contracts, lower utilization rates for its fleet, and significant downward pressure on charter rates and service fees. Ezra Holdings had aggressively expanded its operations over the years, funding much of its growth through debt. According to Ezra's financial report in 2016, the group incurred a loss of over $1 billion. Furthermore, in 2015, the company had current assets of about $2.6 billion and current liabilities of $2 billion. A year later, the company had only $622 million in current assets and current liabilities amounting to over $1.5 billion. In other words, it had far more current liabilities than current assets. In case you're not aware of this concept, current liabilities are what the company has to pay within 12 months, whereas current assets are funds the company has access to in 12 months. This high level of indebtedness became a critical vulnerability as the company's revenues began to fall sharply due to the industry downturn. So with declining revenues and continued high debt servicing requirements, Ezra faced severe liquidity constraints. The company struggled to meet its short-term financial obligations, leading to a series of defaults on its loan repayments. The over-leveraged balance sheet also meant that Ezra had limited financial flexibility to navigate the downturn or invest in new opportunities that could have helped stabilize its operations. The company's stock lost a fifth of its value in early March of 2017 after disclosing that it had provided guarantees on nearly $900 million in liabilities and loans of MS Chiyoda Subsea, an affiliate that also filed for U.S. bankruptcy. The chief restructuring officer, Robin Chiu, stated that there was an oversupply of offshore supply vessels along with the influx of newly built vessels, resulting in low competitive charter rates, compounding the financial difficulties of Ezra's business divisions. Of the $1.5 billion in loans, Singapore lender DBS faced the single biggest hit. The company and many analysts blame the downturn of the industry, but there were also problems within its management. The first issue: insider trading. In January 2016, Lionel Lee sold over 11 million shares 2 days before Ezra announced a significant quarterly loss during the company's blackout period. This sale, given the non-public nature of the loss details, suggests insider trading, breaching the company's governance policies. Secondly, Ezra's financial issues predated the oil market crash. The company had negative free cash flows for a decade due to excessive borrowing. The listing of of multiple group companies controlled by the founding family created complex interdependencies and multiplied risks. Interlocking directorates and conflicts of interest further weakened corporate governance. And thirdly, there was an incident involving a property purchase by Tryards and Henderson Supply Base. They stated that there was no interest from the directors. Yet in 2015, it was revealed that Lionel Lee, then non-executive chairman, had a beneficial interest in a related company, violating listing rules and the Companies Act. Similarly, a 2009 acquisition by Ezra's subsidiary lacked disclosure of the Lee's indirect interest through Moonshine Investments International Limited. So to sum up the downfall of Ezra Holdings, they grew too fast and used too much debt to fund that growth. There were also issues with transparency and management within the ranks. But anyway, do let us know what you think. Thanks for watching.